Management of exchange rates in 2008-2009. Intervention by RBI in diluting forex reserves. Exchange rate. The cascading effect of the global financial crisis on the domestic foreign exchange market was felt through the dollar liquidity shocks emanating from the lower level of net capital inflows. Despite the deepening of the financial crisis and weakness in economic activity in the US, the flight to safety considerations helped the US dollar to strengthen against most currencies during 2008-2009, including the Indian rupee, particularly since the middle of August 2008. The Indian rupee exhibited greater movement during 2008-2009, moving between 39.89 rupees and 52.09 rupees per US dollar. The rupee generally depreciated during the first half of 2008-2009, reflecting FII's outflows, high inflation, and higher crude oil prices, indicating higher demand for dollars. The rupee, which stood at 39.99 per US dollar as at end of March 2008, was generally range-bound up to April 2008, but subsequently depreciated and moved in a narrow range of 42 to 43 rupees per US dollar from the third week of May to the middle of August 2008. With the intensifying external shocks, it depreciated sharply thereafter, breaching the level of 50 rupees per US dollar on October 27, 2008. Initially, because of higher crude oil prices, demand for dollar increased, which resulted in appreciation of dollar, a downfall of rupee, and after Lehman bankruptcy, that is between August and September 2008, and onset of financial crisis, FIIs started withdrawing their money from portfolio investment, resulted in exorbitant increase in demand of dollar. Rise in demand of dollar has resulted in increase in its prices, and the exchange rate reached 50 to 55 rupees per dollar. The measures taken by the Reserve Bank since September 2008 were essentially to improve foreign exchange liquidity by way of selling dollar into market, raising interest rate ceilings on non-resident Indian, that is NRI deposits, providing flexibility to banks to borrow in overseas markets, liberalizing premature buyback of foreign currency convertible bonds, that is FCCBs, and relaxation of ceiling interest rates on short-term trade credit and external commercial borrowings, that is ECBs. The dollar price came in control. Despite significant easing of crude oil prices and inflationary pressures in the second half of the year, declining exports, sustained capital outflows, and strength of the US dollar against other major currencies continue to exert depreciating pressure on the rupee, taking the rupee-US dollar exchange rate to a low of 52.09 rupees per US dollar on March 5, 2009. The Reserve Bank's actions in the foreign exchange markets, which were guided by the influence of large volatility created by capital inflows till May 2008, shifted to meet the rising demand of foreign exchange on account of the widening trade deficit and capital outflows in the subsequent period. Consistent with its policy objective of maintaining orderly conditions in the foreign exchange market, the Reserve Bank sold foreign exchange to meet the mismatch in the market.